MSG Sports, ticker MSGS, isn't just a buy, it's a screaming buy, on track to deliver 30% upside in the next 12 months, all thanks to Jalen Brunson. This isn't about the playoffs, it's about a foundational shift in how sports franchises create value, and it's a playbook Canadian investors need to understand. Invest IQ here. Today, we're dissecting three things. First, why the market consistently undervalues sports teams, especially those with iconic brands. Second, the specific, tangible ways the New York Knicks' resurgence under Brunson has already boosted MSGS's bottom line, far beyond ticket sales. And third, the number nobody's printed yet, the hidden asset on MSGS's balance sheet that makes it a prime M&A target. Let's start with the fundamental disconnect. Why do analysts, even smart ones, keep missing the boat on sports franchises? Look at the S&P/TSX today, up a decent 0.8%. Banks like Royal Bank are flat, TD is up a bit. Crypto's mixed. It's all very predictable. But sports? Sports is emotional. It's tribal. And that tribalism, that irrational loyalty, translates into incredibly sticky, high-margin revenue streams that traditional valuation models struggle to capture. Think about it. A bank's customer might switch for a better interest rate. A Knicks fan. They bleed orange and blue, win or lose. That loyalty means they'll buy merchandise, subscribe to streaming services, and show up to games, even when the team is mediocre. But when the team is good, like the Knicks are now, that loyalty explodes into a goldmine. Graphic, chart showing MSGS stock performance versus S&P 500 over 5 years. Highlight Knicks' recent performance surge with an arrow pointing to a corresponding MSGS stock uptick. The evidence is clear. Before Jalen Brunson arrived, the Knicks were an afterthought. The buzz was gone, the garden was often quiet. Then Brunson came, and everything changed. The energy shifted. The wind stacked up. And MSGS's stock, while it's had its ups and downs, has shown a clear correlation with the team's on-court success. This isn't just anecdote, it's data. Consider the tangible impacts. Ticket prices. Up. Sponsorship deals. Larger and more numerous. Media rights. More valuable because viewership is up. And crucially, the halo effect extends to the other assets under the MSGS umbrella, primarily the New York Rangers. A vibrant, winning Knicks franchise elevates the entire MSG brand, creating cross-promotional opportunities and boosting overall enterprise value. It's not just about the current season either. Sustained success builds a new generation of fans. These are lifetime customers, effectively. Think about the Toronto Raptors championship run in 2019. It wasn't just a fleeting moment, it cemented a fan base for years, boosting merchandise sales and brand recognition globally. The Knicks are in the early stages of a similar trajectory, and the market, in its usual short-sighted way, is only pricing in the immediate upside, not the long-term compounding effect. Now, for the really interesting part, the number nobody's printed. MSGS holds a hidden asset, a dormant giant on its balance sheet that traditional analysts overlook. We're talking about the real estate underlying Madison Square Garden itself. Graphic, satellite image of Madison Square Garden, with a callout showing the estimated land value per square foot in Midtown Manhattan. Madison Square Garden sits on some of the most valuable real estate in the world, right in Midtown Manhattan. While the company is publicly traded as a sports and entertainment entity, the underlying land value, if assessed at current market rates for prime commercial real estate in that exact location, is astronomically higher than its book value. This isn't a theoretical exercise. In a world where private equity is constantly looking for undervalued assets, a company with an iconic brand, recurring revenue, and a massive, undervalued real estate footprint becomes a prime target. Imagine the possibilities: a sale of the property, a sale-leaseback arrangement, or even a full take-private deal where the acquirer unlocks that real estate value. This isn't just about the Knicks winning, it's about a conglomerate with a strategic asset that has yet to be fully monetized. The strong performance of the Knicks, driven by Brunson, only enhances the overall appeal, making MSGS an even more attractive acquisition target because the sports business itself is thriving. That's a double whammy for investors, a growing core business and a massive hidden asset. Now, the strongest counterargument: what if Brunson gets injured? What if the Knicks revert to their old ways? It's a fair point. Sports are inherently unpredictable. But this thesis isn't solely dependent on a single player or even a single championship. It's about the re-establishment of a winning culture and a premium brand. Even if there are dips, the foundation has been laid. The fan base is re-energized. The infrastructure for sustained success is in place. And critically, the real estate value isn't going anywhere, regardless of the Knicks' on-court performance. It acts as a significant floor to the stock price, limiting downside risk. The takeaway for Canadian investors is this: don't dismiss sports teams as purely speculative bets. Look for the underlying value, the brand equity, and critically, the hidden assets. MSGS, fueled by the Knicks' resurgence and anchored by its invaluable real estate, is a compelling investment opportunity right now. It's not just about buying a team, it's about buying a piece of prime real estate and a revitalized entertainment empire. That's the InvestIQ take for today. Analysis only, not financial advice.